Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today, we're tackling a question that I've been starting to get a lot of questions around, and that's what to do with your cash investments or savings. For the past 2 years, cash was king. You could park your money in a high yield savings account or a money market fund and watch it earn 5+%. People were actually starting to look again at their bank statements to see how much interest they were earning per month. It felt like free money. But lately, you've probably noticed those monthly interest deposits are getting smaller. If you feel like the party is over, you're not entirely wrong, but the opportunity hasn't disappeared, it's just moved. Today, we're going to look at why your rates are falling and, more importantly, where you can pivot your cash to keep your wealth working as hard as you can. All right, let's set the stage. From 2022 to 2023, the Federal Reserve hiked interest rates at a historic pace to fight inflation. We went from near zero rates to over 5% almost immediately. But as we moved through late 2024 and 2025, the narrative shifted. Inflation cooled, and the Fed began a series of measured rate cuts. As we sit here in May 2026, the federal funds rate has settled into the mid threes within a range. When the Fed cuts, the first place you feel it is your floating rate accounts, and that's your savings account, your money market funds. They drop almost instantly. However, longer term rates, like the 10-year Treasury, haven't dropped as fast. This means we're seeing a steepening yield curve in plain English. The easy 5% that you get on those online savings accounts are gone. And to get better returns, we have to look at different buckets of risk and liquidity. So let's break down the options you have using these 4 pillars: risk, liquidity, the interest rate you'd receive, and the tax consequences of your investment option. First bucket, we have your high yield savings and your money market funds. So these you can think of as your ultimate safety and liquidity. But however, the rates are variable. As rates fall, these are the first to lose steam. There's a little confusion around money market funds. So I'll provide a quick explanation. A money market fund is a type of mutual fund that invests in highly liquid, short-term, low-risk debt securities. So you can think of it as a mutual fund for cash. The primary goal of the money market fund is to maintain a net asset value of $1 per share. So that means when you put in $1,000, you own 1,000 shares. The interest the fund earns is paid out to you as dividends, usually monthly, but the share price is pegged to stay at $1 per share. If the value drops below $1, it's called breaking the buck, which doesn't happen often, and that's the risk that you're taking here. The fund manager takes your cash and buys very boring things that mature in a short amount of time, usually 13 months or less. These include things like Treasury bills, which are short-term government debt, certificates of deposit, which are large-scale bank deposits that we're familiar with, something called commercial paper, which are short-term IOUs from highly rated corporations like Apple or Walmart, and then something else called repurchase agreements or repos. And these are short-term loans backed by government securities. So dependent upon your tax situation, there are different types of these money market funds. So you have these government and treasury funds, which invest only in U.S. government-backed debt. These are the safest type, but usually have slightly lower yields than the other 3. There's prime funds that invest in floating rate debt and commercial paper from corporations. These usually offer the highest yield, but carry a little bit more risk. And then there's also these tax-exempt muni money market funds, which invest in short-term municipal debt. The interest here is federal tax-free, which is great if you're in a higher tax bracket. On the risk liquidity aspect of these money market funds, the risk is very low, but you have to note these are not FDIC insured. So unlike a bank account, these are investment products. The protection comes from the high quality of the underlying short-term debt that these funds contain. Liquidity is very high. You can usually sell your shares and have the cash ready to withdraw in 1 business day. Interest rates, they're highly sensitive to the Fed. So when the Fed cuts rates, the yield on these money market funds drops almost instantly because the short-term debt they hold matures and it's replaced by newer, lower paying debt. These dividends are typically taxed as ordinary income at the federal level, unless you invested in these muni money market funds, which are tax exempt at the federal level. I often tell people, don't just look at the yield. You want to check if it's a treasury money market. Is it a prime money market? If you're worried about bank stability, the treasury money market, it's one of the safest places for your cash because it's backed by the government, and not a single bank's balance sheet. All right, second option, we got certificates of deposit or CDs. So if you think rates will fall further from where they are now, CDs let you lock in today's rate, and you can get a CD for 6 months, a year, 2 years, 5 years. The trade-off is that you lose liquidity. So if you break it early, or if you sell the CD early, you pay a penalty, or you lose some of the interest that you've received. But it is a great bridge for money that you don't need access to immediately, and maybe in 12 months or 24 months. Interest on these are taxed as ordinary income in the year, each year that you earn interest on it. Third bucket, we have U.S. Treasuries. These often yield slightly more than bank CDs right now. Treasuries are exempt from state and local taxes. Some people kind of dismiss that and don't even think about it. But if you live in a high tax state like New Jersey, New York, or California, a 4% treasury might actually put more in your pocket than a CD at 4.2% or 4.3%. Next is the fourth option, which are Series I savings bonds, or more well known as I bonds. So these were a fan favorite from the high inflation days of 2022, the Series I savings bond. While the headline rates aren't the 9% that they were paying back then, they're still a powerful tool for the patient cash in your portfolio. So you want to think of an I bond. It's a government-backed savings bond that's mathematically guaranteed to keep up with inflation. You buy them directly from the government via treasurydirect.gov. There are a couple of specifics about I bonds that are different than other things. One of them is that you're limited to buying $10,000 per person per calendar year. And there's some ways to increase that amount, whether it's multiple people or if you're buying some through a business. There's a little confusion around how the interest rates work on these. An I bond rate, it's actually two rates added together. So you have a fixed rate. This is set when you buy the bond and never changes for the 30 years. As of May 2026, the fixed rate is 0.90%, 0.9%. Now, the inflation rate, which this resets every 6 months in May and November, and this is based on the consumer price index. So when you add that 0.9% fixed rate to the current semi-annual inflation rate, you get a composite rate or a total rate of 4.26%. So even if inflation drops to zero, you still earn that 0.90 real return above inflation, which is actually a better floor than you'll find in most savings accounts. Now, here are these specific rules to the I bond that I was talking about. So first, with respect to liquidity, there's a 12-month lock on them. You can't touch the money for the first year, no matter what. And then there's also a 5-year penalty that you have to think about. The way this works is if you cash them out before 5 years, the 5 years of when you purchase them, you lose the last 3 months of interest. After 5 years, that penalty disappears. Now, the tax treatment, which is actually pretty good. They're state and local tax free like a treasury. You don't pay any state or local taxes on the interest. They're tax deferred, so you don't pay federal taxes every year. You only pay them when you cash the bond in. So this allows your interest to compound grossly for up to 30 years. And there is a benefit to tax deferral versus paying the tax every year. And there's also an education loophole with these. So if you use the proceeds for qualified higher education expenses, the interest may be 100% federal tax free. It is subject to income limits, but it's a sneaky alternative that has similar benefits to a 529 plan for some families that fit the income limits on it. So fourth option, we're going to talk about fixed income annuities. These are like insurance company CDs. So they often offer higher rates than banks, and the interest grows tax deferred. Again, that means you don't pay taxes until you take the money out, which makes them powerful for long-term safe money. The liquidity, they're not as liquid as money market funds or high yield savings. You do want to check if you are going to invest in one of these, you want to check what the surrender charges are if you sell prior to its maturity. You can think of a surrender charge as a penalty. And while annuities don't have federal backing, they do have a robust safety net system managed at the state level. So every state has a life and health insurance guarantee association. And so what that means is by law, any insurance company licensed to sell annuities in your state must be a member of the association. If an insurer becomes insolvent, the association steps in to ensure policyholders are protected. They may transfer your contract to a healthy insurance company or continue the payments themselves. They vary state by state, but most of them follow something called the NAIC model law, which typically provides 250,000 to 300,000 in present value annuity benefits. Some states like New York or Washington provide higher limits up to 500,000. They're generally per person per insurer. So again, you can play that game where you're spreading them across different people or different insurance companies if you want more coverage. Those are kind of like your basic, I'd call them lower risk cash alternatives. Next, if we go into the moderate list, you're looking at something like municipal bonds or munis. With this, you're lending money to a city or state. Really, the benefit of these is that your interest is usually federal tax free. So, investors in the highest tax brackets, you want to look at the tax equivalent yield on a muni. Sometimes it's the highest safe return that's available. So, as far as risk with muni bonds and corporate bonds, which we'll take a look at next, you want to ensure you're comfortable with the credit worthiness of the issuer of the bonds. So, if you're going to lend money to a city that's in a really tough time and distress, you want to be careful because that city may default on their loans. And to really explain it in more detail, in the world of fixed income with these munis and corporates, even treasuries, you're the lender. If you lend money to a blue chip company or a stable state government, you would expect a lower interest rate because the risk is low. If you lend to a struggling startup or a financially distressed city, you want to demand a higher rate, which is called the risk premium. If an issuer's creditworthiness drops after you buy the bond, the market value of your bond will fall even if interest rates stay the same. This is called the credit spread risk. And the most common way to evaluate credit, it's through the big three credit rating agencies. So you got Standard & Poor's, S&P, Moody's, and Fitch. And they categorize bonds into two main buckets. So you have investment grade, which there's usually a high confidence that they'll repay you. And the ratings could be like AAA down to triple B minus for S&P, and they all each have their own different ratings of investment grade. But these are usually like your safety bucket of muni bonds or corporate bonds. Defaults in this category, they're usually pretty rare, but they do happen. Then you have your high yield or junk bonds. So these are speculative. The issuer has a higher debt load, it's got inconsistent earnings, and these are usually rated BB plus and below. The reason why someone would buy these are you're looking for income growth and can handle the stomach, the stomach churning of the potential price swings. So those are munis. Next, we got corporates, where here you're lending to like an Apple or an Exxon instead of the government. The risk here is higher than treasuries because a company could go bust, though unlikely for investment grade. And you have a company like Apple or Walmart. There's some you can make an argument that they're actually more stable than some governments, including maybe ours. But you get a spread or extra interest to compensate you for that risk. Liquidity on a corporate or a muni bond. If you sell before the maturity, you could see your principal increase, decrease, or stay the same. It's mostly based off of what's going on with interest rates. However, like we mentioned above about the creditworthiness, changes in that could also change the principal from these bonds. All right, now I'm going to go into the more higher risk of investing, and we'll take a realm into dividend-paying stocks. So here you're going from lending to owning. So here your principal fluctuates with the stock market. So we all know the volatility that can go on there. However, as interest rates fall, like in a period that it seems like we're moving into or into now, dividend stocks become more attractive to investors. And the reason is because you get the dividend income, the check but you also get the potential for growth of the stock price appreciating. So it's not really an apples to apples comparison with some of the other investment options we discussed. But if you're looking for, or if you're okay with both income and growth, they may be an option too. And one thing I mentioned, we're going over 8 options, but it's usually not one option. A lot of times you can mix and match or put multiple of these options together to build your portfolio. But if you're sitting on cash, you're essentially watching you're every time the Fed meets, especially in an environment where interest rates trend downward, you're potentially losing money each time they meet. But the goal is not just to find the highest interest number. You want to, one, look at what's the highest after-tax return number that matches when you need the money, liquidity, and with the right amount of risk that you're comfortable with or that makes sense for what you're trying to do. So that's all I have for you today. I want to thank you for joining today's episode of The Agent of Wealth. If you want a custom cash audit to see which of these options or how to build a portfolio based off of these, reach out to the team at bautisfinancial.com/call. Don't forget to follow The Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.